Hello class, this is Dr. Fenton. In this video, we will cover Chapter 8, which discusses performance evaluation. We're going to talk in a little bit of detail about flexible and static budgets, various variances, then also standard costing. Let's get started. Flexible budgets. If you think about the last chapter, we prepared a budget for the upcoming months or years at a certain level of activity. So we planned on maybe having a certain level of sales, and we prepared an entire budget based on that. Probably in reality, when you actually get through that actual year you budgeted for, you will not be at that exact same level that you set the budget at. So we need to be able to find a way to find a budget at various levels of activity. This is called flexible budgeting. Let's see how it works. Here are the numbers to start with. We have a per unit sales price and variable cost, and then we have a total fixed cost amount. When you look at this budget, or these set of numbers, don't be confused. This is not supposed to add up to total fixed cost. Maybe they should have had a double underline here, and maybe it would make it more clear. But anyway, the expected sales price is $80 per unit. You can see the unit cost for materials, labor, and overhead, and also general selling administrative cost. Here is a flexible budget. The initial budget we thought we would actually be at, when we first made the budgeting process, was 18,000 units being sold. That's called a static budget, just at one level. We have the selling price, all the same unit cost we talked about, and the fixed cost go down here. What you can do then is now take these numbers and prepare a budget at any level. We're flexible here. So if we end up maybe only selling 16,000 units, we can see what the budget should look like at 16,000. If we sell 20,000 units, same thing. You can see what the budget should look like if we sell 20,000 units. Now the thing to watch out for is, look, the selling price per unit is 80. Now as we should expect to sell more and more units, of course the selling price budget or the sales budget will actually go up. Okay? So sales revenue is expected to increase as units we sell increase. It just makes sense. Same way with your unit cost. These are the variable cost. Variable cost per unit, all these will be taken times the 16,000 to get these numbers, 17,000 these numbers, and so forth. So what's changing will be your revenue. You sell more, you have more revenue. You sell more, you have more variable cost. But then look at this. Fixed cost should not change among the levels. If this is a truly fixed cost, and we are still within the relevant range in all these activities, which we are, the fixed cost will not change even though we expect to sell more and more units. And then you can see what the net income is expected to be under each of these levels. So this is a flexible budget. A static budget is a budget for one level. A flexible budget can include that level plus other levels of sales and activity. So this is a flexible budget. So it's a fairly simple concept. Okay, you can read that. Next page. Variance for performance. Now, variance is the difference between a budgeted amount, sometimes called a standard amount, and the actual results. That's a variance. And in the large letters here, they explain the variance. So when actual sales exceed expected sales, you sell more than you expected, that variance is favorable. That's always good to sell more than you expect, right? When actual sales are less than expected sales, variances are unfavorable. Okay? When actual cost exceeds standard cost, actual costs exceed, and you call this a budget cost if you want to, variances are unfavorable. If it costs more money, that's an unfavorable variance. When actual costs are less than the standard cost or budgeted cost, variances are favorable. Now you spent less than you thought. Next page. What we're going to do here then is look at the budget level that we thought we were going to have and compare it to another level. So if you actually, like I said, they actually make and sell 19,000 trophies, units. So instead of 18,000, during the year they actually had 19,000 they produced and sold. Number of units, you sold more than you planned, is favorable. Revenue, you had more than you planned. Well, this is your budget. You should have budgeted for more revenue than you planned. That's favorable. So at the 18,000 unit level, your revenue was $1,440,000. At the 19,000, your actual level, your budget should have been $1,520,000. That's favorable. All your variable costs, these are based on units. These are unfavorable because you had more cost than you had budgeted for. Your 19,000 unit level, you're going to have more cost than the 18,000. It makes sense because you're producing and selling more, but because the cost is higher, 19 compared to 18,000 units, these are unfavorable. Not to say that an unfavorable variance is, quote, bad. This is okay because you actually, produced and sold more units. So don't always think of it as a variance as bad or good. Think about what happened. We had more, should have had more revenue than we'd planned. That's favorable. We probably have more cost than what was planned. That's unfavorable. Okay. Fixed cost did not change. There's no variance. You're comparing one budget level to another budget level. These are not actual numbers yet. This may be your actual level of activity, but what you've done now is prepare a budget based on your actual level of activity. So these are the numbers you should have had at the 19,000 unit level. Okay, and you can read the rest yourself there. Let's see, in flexible budget variances. What we have here is the standard or budgeted numbers compared to the actual numbers after you ended the year. So your selling price was only 78. You had planned for 80, it was only 78. Your materials cost, you had planned for 12, actually it was 11.78, a little bit lower. Variable labor cost, you had planned for 1680, it was higher, 1725 per unit, and variable cost per unit was a little bit higher. What we're doing here is comparing a budget to actual numbers. That's all you're doing. Before we had various levels of activity and various budgeted, predicted numbers at that activity. Here we're taking the actual level of production and sales with the budget, comparing that to the actual level with the actual revenue and cost numbers. So budgeted at this level, actual at this level. We actually had this revenue and actually had all these expenses. Let's see how things worked out. Well, you can see that we are $38,000 unfavorable because remember, let me go back up a little bit. Our actual selling price is only $78. We thought we were going to sell it for $80. That's why, with the same number of units, our sales revenue is unfavorable. So based on a budget, numbers, let's say a year ago, we thought we were going to sell these for $80 each. We sell 19,000. We should have had revenue of $1,520,000. We actually had revenue of $1,482,000. 19,000 times $78 sales price per unit. Now these are the budget amounts we saw earlier in the previous schedule. These are the actual numbers. So to get these numbers here, take these actual variable cost figures for each, materials, labor, overhead. Take those times the 19,000. Materials, labor, overhead. And you can see that at this level, if we'd produced 19, we thought a year ago, we thought we would produce, we thought we'd produce 18, actually produced 19. If you produced 19, you thought you would spend $228,000 in materials. We only spent $223,820. We spent less, favorable variance. For your labor and overhead, those are unfavorable variances because we spent more at the 19,000 unit level than what we had budgeted for. The variable sale administrative expenses, they were less than we probably thought we would have at the 19,000 level, that number is favorable. Now fixed cost. Remember before, this number did not change. Why? We were always comparing one budget to a different budget at a different level. They were budgeted numbers. Fixed cost is a fixed cost. We predict those to stay the same no matter what budget level. But once we have the time period end, the year ends, and we have actual numbers, we found out that we spent $295,000 in fixed cost. We'd planned for spending $291,600, but a variety of items could occur. Who knows what? Maybe there were some insurance costs that went up and so forth. So our actual fixed cost, we actually paid for $295,000. We had budgeted for $291,600. We had unfavorable fixed cost variance of $3,400. And then the net income was lower than it should have been at that level. These are all the predicted numbers at the 19,000 unit level. These are all the actual numbers, revenues and cost. So we were $46,720 lower, unfavorable, than what we really had planned for at that level. This is a way to look at the sales revenue level. Here's the 38 we just looked at up here. Drop it in. This is sort of splitting out what happened in sales. If you remember, a couple of pages ago, we thought we were going to sell 18,000 units at 80 per unit. Actually, we sold 19 at 78 per unit. So our total sales variance was 42,000 favorable. 42,000 favorable. That's made up of our actual activity, our sales volume variance of 80 compared to the 38,000 sales price variance. Now, where are we getting these numbers? I just showed you the 38 right here. That's the sales price variance. I need to go back a page to find the $80,000. Let me do that. Here's the 80. Comparing one budget to another. We thought we were going to have 18,000 units produced and sold. We produced 19,000. The budget should have been, $1,520,000. So 80,000 favorable. That's the volume variance. So that's where those numbers come from. So you can break out the total sales variance into an activity variance and a sales price variance to get to the 42. On the fixed cost variances, don't worry about this. I'm not going to test you over this, so we can just skip this page. Standard cost systems. Now, what we do when we are going to produce a product is part of the budgeting process will be, okay, how much do we think we're going to spend in materials, labor, overhead? Those are the standard cost, the budgeted cost. Now, you can get into ideal standards. Ideally, if everything goes perfect, this is what it should cost. We don't have any waste or spoilage or anything else. Everything runs perfectly. Usually it doesn't happen. So practical standards are what's usually used. We plan for, the typical things that might go wrong, some inefficiencies, some things happening, deviations. We think we can hit these standards, the practical standards. Lax standards, very easy to attain. It might not motivate people to do their best. So probably the practical standards is the best way to set a standard cost system up. Okay, so you can read through here. And let's look at some numbers. Okay, so remember earlier we thought we would spend $12 per unit on materials. We actually spent $11.78. Okay, that's a favorable variance. We did spend more in labor and overhead per unit on the variable cost than we thought we would. So let's look at here are the variances. It's just taking the amount, actual cost minus budgeted cost, standard cost times the actual level. So these are the various variances that we have: 1 favorable, 2 unfavorable. Okay. Let's take just the materials price variance. Let's break it out a little bit. So here's what they have. Price per pound, they use 6.2 pounds of material. That's what the actual data. We actually paid less, used a little bit more per pound, and there's the cost per unit. We had thought we would spend $2 per pound and use 6 pounds, and that's where the 12 came from. So this is showing you some background of where they thought the budget would be in the standard cost. This is what actually occurred. We paid less, but used more pounds per unit. We thought we would pay $2. We thought we'd use 6 pounds. We paid $1.90, used 6.2 pounds per unit. Okay, and the actual production volume, thought we, at this flexible budget level, 19,000, actual produced 19,000. Here's the quantity. We used 117,800 pounds actually. We thought we were going to use 114,000 pounds based on the budgeted standard cost data and standard usage data. All right, actual cost in total compared to the standard cost in total. Look what we're doing. Actual quantity used times actual price, we paid $223,820. The budget, the standard called for using only 114,000 pounds to pay $2 a pound, $228. So we ended up actual cost less than the budgeted standard cost, favorable. Part of the difference is due to price. Part of the difference is due to quantity used. So let's take this 4180 and split it out into two different variances. We do that right here. Actual cost, actual quantity used, actual price per pound, multiply. We saw that number right here. We have a new column here though. This is the actual quantity used, same number, but the standard price we should have paid for that, the $2. So the only difference between this column and this column will be the price used. That's why this is the materials price variance. So the price variance is 11,780 favorable. Based on what we actually purchased, compared to what we actually paid per pound, compared to what the standard called for, $2, we paid less. And so we have a favorable materials price variance. The third column, this is the 228 right here. Third column. Look at the difference between the second and third columns. Actual quantity used, standard quantity. Based on our budgeted numbers, we should have used 114,000 pounds. We used more than that. We used the standard price here. So if you see, the only difference is actual quantity compared to what we should have used, standard quantity. This is why it's a usage variance. Sometimes in other books it's called a quantity variance, materials quantity variance, materials usage variance. Based on how much we used, irregardless of the price is the same between the two. Usage-wise, this is the variance. It's unfavorable. We used more than we planned. So we have a favorable price variance, materials, quite a bit. A materials usage variance, unfavorable to some extent. Net these two out, and we get to the same 4,180 overall favorable variance. Can I bring this? I can barely keep it all on the same page, but I did it. What you want to do is not just look at totals from one side to the other here and say it was favorable. That's great. We don't need to change anything. Well, you can split this out and give your company more information. What comprised this overall total variance for materials of 4,180 favorable? Well, part of it is due to the price. We paid less than we thought we were going to. That is favorable. Possibly, since you paid less per pound, maybe, this is one thing to look at, was the quality not as good as it should have been? Did that cause you to use more pounds than you should have? Again, we don't know that by looking at this schedule. It's something to look into. You want to find out, why did we use more than we should have? Was it because we spent less from a supplier and got a lower quality and had too much waste? Okay. So you look at this, why did we pay less? All right, that's fine. It's always great to pay less. But did that trigger us using more and waste the materials? So that's what you do for materials. You can split this out and see more than just the overall variance. It gives you more information about your company. Here's an algebraic solution. I don't care for this solution that much. I think you do this, and it's like a pictorial form. You can see what's happening. So I'll let you look through this yourself, but I like this one better. And let's see what else we got down here. Labor variances. You can do the same thing in it. We have price per hour. We thought we were going to pay 12, only paid $11.50. We used 1.4 hours. We thought we were going to. We used more than that. So that's why the per unit cost was higher than we had budgeted for. Actual data, 19,000 units. That means we should have used 1.4 times 19, 26.6. We used 28.5 because our actual usage for labor was more than the standard called for. This is a setup similar to the materials. You look at the actual hours used from up here, actual price paid. We saw that in a little bit, the schedule a little bit higher. Compare that to actual hours, same number, but the standard price. So since we paid less per hour than we'd budgeted, that's a favorable variance. How many hours should we have used? We should have used 26.6 from up here, based on our standards. We used 28.5. So the only difference again between this column and this column will be the usage, in this case hours. Using the same standard price per hour here, 12 and 12. So the difference is usage of hours, so we have a labor usage variance. Okay? It's unfavorable because we used more hours than we should have at that level of activity. We paid less per hour than we had planned for, so we have favorable price variance for labor. Sometimes this is called a labor rate variance. It means the same thing. So instead of having just one variance to look at overall, 8,550 unfavorable, we now have more information. How is this comprised? A 14,250 favorable late variance, paid less than the budget called for, but we used more hours. One thing to look at, and this schedule here does not show this, but one thing to look at. Since we paid less per hour, were we using people with less experience? Did that cause us to use more hours than the budget called for? We paid less per hour was because we used inexperienced workers and we had more usage on the number of hours than the standard. So similar variances between materials up here, right here, and labor down here. This deals with amount you're paying, materials or price. This deals with usage between these two columns, either material or labor usage. Okay, so you can read through this. Don't worry about the overhead variances. Let's go to the next page. And we're at the end of the chapter. So again, as always, go back and read the chapter word for word. Follow all the examples through, and good luck with your studies.